So to me, if the 10-year takes out 5, we're all the way in it. And I think we're probably pretty close to all the way in it based on the recent price action in silver and gold, literally as recently as last week and this weekend. I mean, as you know, silver is now through $40, which is enormous overhead resistance. I mean, like, 20 or 30-year overhead resistance. And, gold is now broken out of a big bull flag at 3,500. It's not there. It's it's at 3,500. And so I believe they have a lot of room to run. And people have asked me my outlook. I mean, I think we see 4,000 this year and probably 5 the next year. And
the bond market is currently flashing subtle warning signals while precious metals are experiencing a dramatic surge. According to investment manager Lawrence Lepard, who has consistently warned about the dangers of fiscal dominance and uncontrolled monetary expansion, this market dynamic is particularly striking as silver has decisively broken through the psychologically significant $40 barrier, obliterating resistance levels that had held for decades, while gold has rocketed past $3,500, emerging from what technical analysts describe as a long-term bull flag formation. These simultaneous breakouts suggest that sophisticated investors are positioning themselves for an extended period of fiscal instability and inflationary pressures. Lepard draws a critical historical parallel. The last time the U.S. implemented yield curve control, after World War II, when debt to GDP stood at 130%, inflation spiked dramatically, reaching 17% and even 21% in some months. He stresses that when interest rates are manipulated rather than set by natural market forces, the outcome is either extreme enrichment of borrowers at 0% or devastation for families when rates soar to 20%. Now, with gold futures surging into uncharted territory, Lepard argues this is not another short-lived rally but the true breakout after decades of suppression. He cites data compiled by Brent Johnson, showing that if US M2 money supply were fully backed by gold, the implied price would be around $90,000 per ounce. Even a partial 20 to 40% backing, consistent with past gold standards, would imply prices many multiples above today's levels. With gold at $3,500, Lepard sees enormous upside. $4,000 within this year, $5,000 the next, and potentially $10,000 within the next 5 years or beyond. Before we dive deeper into these insights on gold, silver, and the broader financial system, make sure to like this video, subscribe to the channel, and tap the bell icon so you never miss the latest updates.
no, isn't it amazing? U.S. credit spreads are tight as can be, and the 10-year's hung right in there. I mean, it's now, but to be fair, on the 10-year, Besant has been doing what Groman calls, kind of shadow QE twist, which is to say he's been selling short-term bonds and then using the proceeds to buy the longer stuff, right? So he doesn't want the so the real the real important thing that's going to come up here, and actually my partner pointed this out to me this morning, is okay. So they're going to take rates down. Then what happens to the U.S. 10-year? I mean, I've really kind of got my eyes peeled on the U.S. 10-year. We know if it goes above 5%, they've got a problem, because we saw that happen in September 2023 and they panicked.
Right.
12 Fed governors talking about how the rate hike cycle is over. So to me, if the 10-year takes out 5, we're all the way in it. And I think we're probably pretty close to all the way in it based on the recent price action in silver and gold, literally as recently as last week and this weekend. I mean, as you know, silver is now through $40, which is enormous overhead resistance. I mean, like, 20 or 30-year overhead resistance. And, gold is now broken out of a big bull flag at 3,500. Bitcoin has not followed yet. I got some interesting data on that if you want to discuss it. But, to me, it's like kind of like we're in it, in my view. And, I definitely noticed in the portfolio I manage, I mean, all the gold stocks I'm involved with are, and you mentioned earlier, I think in another video, you said how you'd had your first, 10 bag or something, one of your gold stocks. I mean, we've had some of that too. It's crazy, right? And so to me, what's happening is the world is waking up to this problem of fiscal dominance, the problem that the government can really only solve it by printing money, and that debasement, yes, it's bad, and guess what? It might get worse. And to me, that's the biggest thing. When I listen to all these podcasts, the thing that I feel like enough people aren't screaming about is how bad the inflation is going to get. I mean, I've got some data points. The last time we had yield curve control was right after World War II, and they were dealing with 130% debt to GDP at that time. And the Fed had locked in the short rate at 3/8 and the long rate at 2.5%. And this all was before the Treasury Accord in 51 when they changed it. But in like 47 and 51, they had 1 month where inflation was year on year up 17%. They had another month where year on year it was up 21%. I mean, these were eye-peeling inflation numbers. That was all because they were doing yield curve control. They were holding those rates low. The only way they could hold those rates low was to print the money and expand M2, and it grew massively. And then that led to inflation. And I was kind of like, okay, this is going to rhyme. You know, I can see where this is going, you know. So we're not there yet, but it feels to me like we're very close to the edge on that. We must, and we will, and just natural forces will cause us to drift back to sound money, which is not to say the dollar will necessarily disappear, but the dollar is going to have a lot of competitors. And certainly the bond market, you know, I look at gold and Bitcoin as really reserve assets, not necessarily reserve currencies. And currency, as you know, has two pieces to it. It's a savings vehicle, it's a store of value vehicle, it's also a medium of exchange vehicle. Well, in today's world with technology, you can exchange one thing to another in a heartbeat. You know, you got Venmo, PayPal, dollars, yen. I mean, it doesn't matter. The currencies will all be out there, you know, for payments. But what people will be willing to hold that they trust will be gold, silver, and Bitcoin, in my view.
Okay.
And those will come center stage, and perhaps even to the point where I you know, I kind of dream and think in my book, and we're talking, you know, probably after I'm gone, we're talking 20 plus years out here. I actually believe my kids might be doing transactions of Satoshis, which is the smallest unit of one Bitcoin. So, you know, and the dollar might be a thing of the past, and everybody might be saying, well, you know, how could it be that you guys let 12 people in a market-based economy set something as important as the price of money? I mean,
All right.
we all know price fixing doesn't work, that, you know, the interest rate ought to balance the supply of savings against the demand for capital. That's what the interest rate should be. It should be set in the free market, full stop. But of course, what we have is a bank and government cartel that sets it. And that's why we have all these problems. I mean, you know, look at it, Adam. You have 0% interest rates, you know, which makes everybody who can borrow wealthy, or you have 20% interest rates that almost banked my dad in, you know, in 1980 when we were eating tuna fish sandwiches for dinner for weeks on end. I mean, it's just, you know, it's kind of it's just an up and down system that's very painful because it's run by a cartel that is, you know, the banks and the governments. So it's a breakout, and it's a breakout after many years of suppression. And, you know, if you kind of, some people would say, well, these are too expensive, they have to come back down. And I would say, no, no, no. You need to compare them to the outstanding money that we've created. And, you know, I mean, Brent Johnson has a great table that's actually in my book as well that shows that to fully back the dollar with gold, and this was a couple of years ago, you know, at today's, and 100% backing, by the way, is not required to have a gold standard. I mean, you can run a gold standard at 20 to 40% backing, right? But if you wanted to 100% back the dollar, you know, M2, you know, with gold, you'd have to have $90,000 an ounce gold. Now, you know, it's not there. It's at 3,500. And so I believe they have a lot of room to run. And people have asked me my outlook. I mean, I think we see 4,000 this year and probably 5 the next year. And I can clearly see up to 10, you know, in the next, you know, 5 to plus years. And
Lawrence Lepard's investment outlook blends his views on monetary policy, inflation dynamics, and the role of sound money alternatives. While he continues to hold and value gold and silver, his conviction in Bitcoin has grown stronger over time, largely because of its superior performance at the margin. For new capital allocations, Bitcoin increasingly appears to be the best opportunity, even as his core positions in precious metals remain intact. Underlying this positioning is Lepard's broader macro view. He believes the last inflationary cycle has not been broken and that upcoming changes at the Federal Reserve, particularly the likelihood of a dovish shift in leadership, will only reinforce easier monetary policy. Markets, in his assessment, are already anticipating this outcome. A weaker dollar will inevitably strengthen alternatives like gold, silver, and Bitcoin, which explains why all three are moving higher now. At the same time, Lepard acknowledges that disinflationary or even deflationary shocks are possible, particularly when debt levels become unsustainable. Excessive borrowing pulls demand forward, and when that debt begins to unwind, the resulting contraction can be deflationary. However, he stresses that the policy response ultimately shapes the outcome. In his view, policymakers are far more likely to print and monetize debt than allow a prolonged deflationary cycle, which means the long-term trajectory still favors hard assets. Let's get back to the interview.
I'm stacking and hodling as I go. So what's happened to me, Adam, is that I feel much more bullish on Bitcoin than I do on gold and silver, and which is not to in any way denigrate gold. So I love them, hate it when people knock them. Um, but at the margin, I'm a buyer of Bitcoin, whereas at the margin, I haven't bought a lot of new gold and silver. I bought a lot of gold and silver miners, which is a slightly different kettle of
Yep.
fish with a lot of risk involved. And of course, what's happened to me over the years is my Bitcoin weighting has just become higher because it's gone up faster. And I've never, I'm not into selling my gold and silver. I'm not going to do that. But I mean, let's say I earn a salary at my job, which I do, and let's say I have some excess capital and I want to put it somewhere. I usually look for the best opportunity. I mean, recently, actually, that's been in some gold and silver stocks, but in
Hmm.
general, if it weren't there, I would be a buyer of Bitcoin. And I don't want to get into all the, the Real Housewives of the Fed drama that's been going
Yeah.
on, but but we do know that Powell terms out in May of next year, and the Trump administration is aggressively, campaigning for lower rates. And so I don't think we've broken the last inflation cycle. And I think we can almost be assured that starting in May of next year, we will have a very dovish Fed. And so I think that the sound money alternatives to the dollar, they can all smell that, and that's why they're doing what they're doing. Just the whole notion that we could have disinflation or deflation. I mean, yes, of course, when you build up a lot of debt and you get way out over your skis, you're bringing consumption forward, and so that debt, if it starts to unwind, that's a deflationary event. I mean, a perfect example of this was in 1929. There was a ton of debt, there was a ton of growth, there was a huge bubble, and as it unwound, we had massive deflation. So don't get me wrong, it's not as if we have to have inflation forever, and in fact, deflation usually follows massive inflations. However, we've got to consider the policy response, and we'll get to that in just a minute. But let's look at Hanke. I thought what he said was extremely interesting. Where I really kind of disagree that we could have a disinflationary period, where I really kind of disagreed with him was partly how he's measuring inflation. We all know that the numbers are not really true. And I think he kind of accepts what they tell us as the
Hmm.
accurate numbers. And I think you have to kind of read outside the box and realize that no, that the numbers they're reporting aren't true. But even for the sake of argument, let's say they are true. He said something in his interview with you that I just found kind of stunning, and I disagreed strongly with, where he said, well, yes, I mean, we need, money supply right now is growing at between 4.2 and 4.6%. And if you look at that, Bill just had some great charts that he sent out, shows, M2 has now hit a record high and it's growing at 4.8%, he says. And Hanke said, well, look, it's growing at this rate, but that's not fast enough to keep, the 2% inflation mandate. He made the point and said he believes that M2 needs to grow at 6% to have the inflation target of 2% get hit. And my
Yes.
brain kind of exploded when I heard that, because I was just like, hang on a second. M2 by definition is the underlying definition of inflation. Now, of course, it shows up in different places at different times at different speeds. I mean, insurance costs are high right now. I mean, look, inflation is not an even thing. And then he went on to say, well, yeah, notice how, we took rates down to zero and post the GFC, and, we had a problem keeping inflation at 1 or 2%. And I was like, well, yeah, dude, but, look at asset inflation during that time frame. You had this enormous carried interest bubble that got built, in all the assets. So I kind of disagree with his notion. I mean, I tend to be much more of a hardcore monetarist in the belief that, in the long run, if you look over 50 years, M2 has grown at 7%, and that's the underlying rate of inflation. Now, CPI is going to go up and down. There are all kinds of different things that occur. As we know, COVID drove it up to 9, and then, Powell shrinking the money supply by 4.7% brought it back down to, well, we kind of briefly got it stated at 3, but whether it's there or not, it's open for debate. But anyway, that's it on Hanke. I mean, just to kind of summarize, that's exactly right. I mean,
Yeah.
and I think most people listening to this would just have to agree. I mean, I don't, we are not experiencing 3% inflation today year on year. I mean, I can point to numerous categories where we're well over 3. In fact, this morning I tweeted a chart on electricity prices, average electricity prices throughout the United States, and they're going up at a lot faster than 3% a year. I can tell you that. Now, part of that's based on the AI demand and what I call the AI bubble, and we can get to that later. But and so that's a different matter. That's not necessarily M2 inflation. That's demand-driven inflation. But yes, you're right. I think the inflation numbers are misstated, and more importantly, I really wished in that interview, and I'm sure you can't always interrupt these guys when they're talking. I was kind of like, come on, Adam, ask him how the heck he gets to 2% growth inflation with 6% money supply growth. I mean, that's a disconnect in my mind, anyway.
The trajectory of global markets suggests a future where traditional fiat systems face mounting pressure and alternative stores of value rise in prominence. The interplay between inflationary risks, potential deflationary shocks, and inevitable policy responses underscores a cycle that consistently favors scarce, hard assets over paper promises. What we are witnessing is not simply a market fluctuation, but the gradual unraveling of a financial system stretched by decades of debt and monetary excess. In this environment, patience and conviction are essential, as the forces now in motion are setting the stage for profound shifts in how wealth is preserved, measured, and transferred across generations. How might gold and silver reshape their roles in global finance as confidence in fiat currencies continues to erode? So stay tuned. If you're interested in real, data-backed insights on the financial system, hit like and subscribe so you never miss the weekly updates. And if you follow Bitcoin-related news, consider subscribing to our other channel for more updates. Thank you for your support, and we hope you enjoy the video.